All right, today we're going to tackle a big one, ServiceNow. It's obviously a huge player in the AI and software world. But this isn't just about one company. We're actually going to use it as a case study to build out a professional-grade framework, a playbook you can use for any of these high-growth, high-valuation stocks. This is how you learn to separate a truly great company from a great investment.
And this really gets us to the heart of the matter, the central dilemma. Look, nobody's questioning the ServiceNow story. It's a fantastic company, a true AI leader. But for us as investors, there's a huge challenge staring us in the face. The stock is expensive, and frankly, its technical picture has been looking weaker. So what do you do? How do you balance those two things?
Well, if you listen to the data, the answer is pretty loud and clear. This is a time for patience, not a time for chasing. But, patience without a plan is just wishful thinking. So in this explainer, we're going to build the exact professional framework you can use while you watch and wait for a much higher probability opportunity to show up.
Okay, first things first, we have to clearly define the conflict. With stocks like ServiceNow, it almost always comes down to this classic battle between the undeniable quality of the business and the very real risks that come from a high price tag and shifting market momentum.
And this slide just lays it all out, doesn't it? On one side of the scale, you have everything an investor dreams of, a top-tier AI leader, insane growth, and this incredible compounding earnings power. But, and it's a big but, you look at the other side, and the stock itself is throwing up some warning flares. The valuations is extremely expensive. The stock's momentum has clearly rolled over. The Zacks rank, which is a great independent measure, is just a neutral hold. And maybe most telling, the insiders, they're selling, not buying. That's the conflict we need a framework to solve. So let's start with our first tool, learning how to read the price action like a pro. See, professionals don't just glance at one chart. They analyze what's called the momentum cascade. They look at trends across short, medium, and long-term windows. Why do they do that? Simple. It stops them from getting faked out by short-term noise and shows them the stock's true underlying health.
This chart just visualizes that story perfectly. Take a look back in late 2023. You see all three of those lines, the short, medium, and long-term momentum, were all moving up together, strongly positive. That's the sign of a healthy, powerful uptrend. But now, watch what happens as we get into 2025. Those lines start to roll over, they weaken, and they dip into negative territory. That is a crystal clear signal that we've shifted from an uptrend into a correction.
So the key takeaway here is we can distill all that data into two simple, really powerful rules. Rule 1, you favor making new entries when all three of those momentum timeframes are aligned and turning positive together. That's your green light. And Rule 2, you avoid new purchases when the longer-term trends are negative, like they are right now. This is the kind of discipline that keeps you from buying what might look like a dip, but is actually just a short-term bounce inside a longer-term downtrend. All right, now for the second pillar of our framework, the fundamental tension. This is that classic tug of war between a company's incredible earnings growth and its equally incredible valuation multiple.
This chart really shows you the raw power of the company itself. Just look at the trajectory of its earnings per share. From early 2023 to late 2025, its trailing 12-month EPS shot up by about 5 times. I mean, that is just explosive growth, and that's the reason you're willing to pay a premium for the stock. But the question is always, how much of a premium is too much?
This slide tells the whole story in one single glance. Over on the left, that blue line is ServiceNow's earnings growth. And you can see it's just blasting past the S&P 500. It's not even a fair fight. But then, your eyes go to the chart on the right. And that blue line, ServiceNow's price-to-earnings ratio, is living in a completely different galaxy than the market's PE. And that right there is the core of the problem. The growth is absolutely real and impressive, but the price you have to pay for it is exceptionally high.
Let's put a hard number on that, just so it really sinks in. Recently, ServiceNow has been trading at a trailing PE ratio of around 100. Now, for some perspective, that is roughly 3 to 4 times higher than the PE of the entire S&P 500. When a stock has a valuation that high, it means it's priced for absolute perfection. Any slip-up, any disappointment in growth could cause that multiple to shrink in a hurry, and that's what hurts the stock price, even if the business is still doing great.
Okay, so we have weakening momentum and a sky-high valuation. Now, a professional analyst would not stop there. No way. They add more layers, more objective data filters to either confirm or deny the signal they're getting. It's all about removing emotion from the decision. So here's a simple scorecard using 2 of those filters. First up, the Zacks rank. This is a really powerful tool because it's driven by what analysts are actually doing with their earnings estimates. We want to see a #1 strong buy or a #2 buy. Right now, ServiceNow is a #3 hold. That's strike one. Okay, next up, insider activity. Why does this matter? Because nobody knows a company's true prospects better than its own executives. And the data shows 0 insider buys and significant net selling. That's strike 2. Based on this simple checklist, the data is sending a very clear signal. It's time to wait.
So let's put this all together into an actual actionable strategy. ServiceNow has a 5-for-1 stock split coming up. Now, a split doesn't change the company's value, but it does tend to attract a lot of new eyeballs. So here is the systematic playbook a professional would use to navigate this period with discipline.
This is your 4-step plan for disciplined patience. Step 1. Monitor the momentum. You are simply waiting for the short, medium, and long-term trends to all line up and turn positive again. Step 2. Demand PE compression. You want to see that valuation come down from the stratosphere, ideally below that 90 times earnings mark. Step 3. Wait for fundamental confirmation. This means you require the Zacks rank to improve to a buy, and you need to see that heavy insider selling dry up. Only when, and I mean only when, those conditions are met do you move to Step 4. Execute. And even then, you start with a partial position. This isn't about predicting the future. It's a process for buying strength at a much more reasonable price.
And this really brings us to the single most important lesson from this entire analysis. Look, ServiceNow is, by almost any measure you can find, a fantastic company. It's a leader. It's innovative. But a great company does not automatically equal a great stock. The difference, always, is the price you pay. The professional framework we've built here today is designed to do one thing, to help you wait patiently for the moment when those two things, the great company and the great stock, finally become one and the same.